All right, we'll call to order and roll call.
Okay, Paula Wilson,
Here.
Jason Reed,
Here.
Ron Niebert, Brandon Mechtel.
Here.
Okay, so we do have a quorum of 3.
All right, that being said, next is public comments. Seeing none, move on to approval of minutes. Approval of the last quarterly meeting, if everybody's had a chance to look at that.
Yes.
And any questions, get a motion?
I motion to approve.
Motion to approve the minutes as written.
Then second.
So,
Motion passes. New business. I guess trustee terms, who's up, what? Or is anybody up, or is this just the 5th trustee?
yeah, that's just gonna be it, sorry about that.
Okay.
It's, the 5th trustee vacancy. Palmer, did you have, some input about the 5th trustee?
Yeah, there was a person,
Mike?
yeah, I'm having a brain drain here. Give me a second.
Mike Eisen.
Yeah, Mike Eisen. Mike Eisen talked to me about coming on the board. He has a financial background. That's what he does for his regular business. And actually, he called me just before I was getting ready to call him because I was thinking about him. So he's expressed some interest in it. He called the other day to find out exactly what was next. I told him I thought we'd discuss it at this meeting, but I would recommend him. He's interested. He's got the background.
Does that happen to be the email we kind of got with a
It
little
is,
bit of background
yes.
about him? Okay.
Yep, and I spoke to him on the phone as well. He's got experience with boards, so his.
What's his name? Troy, what was his name?
Mike
Mike.
Eisen. So, it's up to you, Palmer, if you wanna nominate him, we can go from there.
Okay, I'll nominate him for the 5th person position.
You gotta make sure you're using your mic.
Trustee.
Did you happen to look at the,
Yeah.
to check them out? I mean, I'm fine with them.
I'm good with them. Yep.
Okay. I'll second.
Any other discussion? All in favor?
Aye.
Aye.
Okay. Any opposed? Okay, motion passes then. We will get in touch with Mike as soon as we're done here. Okay. So we can go on the tablets if you want to move right down. We'll get straight into the. Too close to me? Too far for me? Okay, so on page 5 of 62 is the new proposed meeting dates. I don't know if I'm too close or if he can fix that squelching. There you go. That's better. Okay, has everybody a chance to look at the dates? Here's the thing, these came from the city as this is available, and then it went to the attorney and consultants. This had to be gone through police and fire, so this was a heavy lift. It's not just, getting our group, it's getting 2 groups together. Some dates are Fridays. Fridays are terrible, but I do have several board meetings that's just how it's worked out. So those are the only dates I could get everybody agreed on across the board with police and fire.
So it's 15th or 23rd, or it's supposed to be the 15th?
The ones on the left were the scheduled, the approved. The ones on the right in the red are the new dates.
Okay.
The main thing was just getting this one set to start with. We can approve something here, and if we had to, like, say we have 2 officers that are going to a conference or whatever, you know what I mean? We can always adjust, but for right now, this is all that we could get through between both boards.
Yeah, I'm inherently fine with them. Do we just have to have someone approve them, I guess?
Yes,
Make a motion?
a motion first.
Motion to approve the revised dates shown in red on the tablet.
Perfect.
Second.
Okay, perfect. Brandon? Okay. Any other discussion? All in favor?
Aye.
Any opposed? Okay, motion passes. Thank you. I will send that so that the town has it, and obviously I'll run this by fire as well. This still has to get through theirs, so I'll confirm with you guys once that meeting is done. Okay, if you want, we'll go ahead and move on to actual expenses. If you want to move to the next slide, slide 6 of 62. So the budget amount from last year was $159,300, and our actual expenses as of September 30th, 2025 was $127,000. As you know, this exercise is, the main goal is that we don't want to be above our budget. So we try to set a reasonable budget with a cushion under each section, just in case. You could see we got close on a couple things, we went over on a couple things, and that's gonna happen from year to year. We may have, more attorney action, we may have more custodian or more investment consultant action, or more on our side, depending on what's going on. So any questions about that? Obviously, when the next budget comes up, things that we're over on, like custodian and things like that, those will be adjusted so that we're not, things that are close, we'll move those accordingly.
Is there a current 26 budget, or?
No, we do have one already in place.
Okay.
So you guys already approved that before. We'll be
Okay.
doing another one coming up in the next, next quarter.
Okay.
But so this was just the tally as of the fiscal year end where we stood on September 30th. So that's when the fiscal year ended. And so those were our total expenses to that point compared to the budget that we had for that same time.
So that September 25th, 2025, so, okay,
Right.
just
Yep.
past history, all right, thanks.
Yep. So any questions on that? If not, I'd like to get a motion to approve the actual expenses as presented.
Motion.
And,
Go ahead. Oh, sorry.
no, I was just gonna say that this is part of the required disclosure. So if as you guys recall, you will adopt a proposed budget each year before the fiscal year, kind of telling the public what we believe we're gonna spend. And then you kind of bookend it with this disclosure, which is the final accounting, essentially, reflecting what we actually spent. So you kind of have both for each fiscal year.
Understood. I'll make a motion to approve.
Second?
Okay.
Second.
Okay, so we're good then. I got Brandon first and then I got Jason. Okay, any other discussion? All in favor?
Aye.
Any opposed? Okay, motion passes for actual expenses, thank you. And then we use those to set the next budget. So I'll run up till when we get ready to do the next budget, I'll run the up to the minute numbers, and then I'll compare that and I'll adjust things as need to be adjusted. Okay. Okay.
All right, next up, Foster and Foster.
Yeah, thank you so much.
Thank you.
Gotta use a different iPad for this.
Just what I need, another tablet.
You guys are keeping Apple in the business.
Yeah. It's the same code, it's in red.
The password is 436-022.
What's the code on this one?
On your agendas.
Oh.
Same for tablets. This way we don't confuse people.
There we go.
So hopefully it'll come right up to page 5 of the report.
Yep,
Everybody got it?
so that's summary.
So it's really a decent report. The bill for the city, so to speak, is on page 5. And we always do it 1 year ahead so the city can budget. So the right-hand column is the 10/1/2024 valuation that determined the requirements for the year we're in right now. And the left-hand column is 10/1/2025 valuation that determined the requirements for next fiscal year. Excuse me. So the cost went down by about 1% of payroll. So that's always good when the contribution requirement decreases a little bit. I'll make you guys scroll back a little bit to talk about the investments, and that's on page 19. So you guys are using a 4-year smoothing technique, but if we just look at the 1 year, towards the top it says development of investment gain or loss, and the market value of assets 9/30/2024 was $23,873,000. So at the beginning of the year we had $23.8 million in there, and we expect to earn 7.65%. So we expected to earn $1,828,000. And we actually earned $2,757,000. So it was a great 1-year period from 10/1/24 through 9/30/25. So that was a net gain above our assumption of $928,000. And then in the upper left, you can see the gains or losses for each of the last 4 years. So the last 3 years have been great, but 4 years ago was 2022, we had a loss of $4.7 million. So this was what we do is we recognize 25% of each of those gains or losses each year for 4 years. So this is the last year we have to recognize some of that $4.7 million loss. So using the smoothing there, we only got 7.22% return. So we had a slight actuarial loss on the investments using that 4-year smoothing. But the good news is that next year, we're only going to have the 23, 24, 25, and whatever we get in 26. So we should have a net gain if we just meet our assumption this year. So the next 3 years look promising based on recognizing some of these gains from 23, 24, and 25. Does anybody have any questions about that page? All right. Then the turnover is a few pages later on page 25. So this page, we had actuarial gains. And so as an actuary, you know, this is when it sucks to be an actuary, because the gains are on the top of the page. We had 8 people terminate non-retirement during the year, and we expected about 5. So there was more turnover than what we expect. And so those people just get a refund. All but one of those people just get a refund of their own contributions. And the other one has to wait and draw their benefit down the road. So that was an actuarial gain. And then at the bottom of the page, sadly, we had 1 retiree and 1 beneficiary pass away. And so that was a little more mortality than we expect. So that was an actuarial gain. So then well, since you're already towards the back, we can go to the state monies on page 40. So that was a good thing. The state monies keep increasing every year. That's based on the casualty insurance premiums for the people that live in New Smyrna Beach. And so you can see, 2021 was 279, then 313, and this year it went from 424 to 479. And then if you go to the next page, there's a frozen amount now of 200,000. And the city can use anything each year that comes in up to 200,000. And anything that comes in above that gets split 50-50 between the share plan and the city. So we got 479, so the city could use 339, and then 139,000 went into the share. So that really helps both the city and the retirees. Now, new people that retire after 10/1/2022, they get a COLA. They don't get the share, but you know that was negotiated. The very last page is page 42, and that's an actuarial calculation of the accumulated funding deficiency or credit for the city. We've been walking this forward since we took over as the actuary, and so the city has a credit there of $208,000, you know, that they can use anytime they want to help offset their required contribution. So now I'll go back to page 15. So your unfunded actuarial accrued liability last year was $6,793,000, and we made each year the city is making a payment to pay that down. So we expected it to be $6,238,000, and in the end it was $6,640,000. So it actually did go down slightly, the unfunded actuarial accrued liability, but that was mostly because of the payment. There was an actuarial loss of $128,000, and then the assumption changes there of $273,000. That was the mortality, because remember the state passed a law several years ago and said all plans have to use the same mortality assumption as the Florida retirement system. And they changed their assumption last year, so we had to change the assumption in this report. So the new assumption thinks people are going to live a little bit longer. So if we think people are going to live longer, then we're going to project to pay more benefits. So that increased the liabilities by $273,000. If you go to the previous page 14, we basically set up little mortgage payments on pieces of that unfunded liability. And so you can see at the bottom the total amortization or mortgage payment, so to speak, is $946,000 a year. So, you know, that's a big piece of what the city's funding requirement is, because they're trying to pay down that unfunded actuarial accrued liability to get us to a 100% funded ratio. Almost done. If we go to page 11. So the top of page 11 is the normal cost, and that's just each police officer accruing benefits each year, and that stays pretty stable. It was 19.7% of payroll last year, 19.8% this year. And then administrative expenses went from 1.6 to 1.9. We use an average of the last 2 years. And then the third line is that mortgage payment to pay down the unfunded. So that went from 23% to 21.7% of payroll. So you add those three pieces together to get that total funding requirement. The members contribute 8, and then the state makes a contribution, and then the city comes up with the difference. And we had talked about that on page 5. So like you can see there, the total was 36.3% from the city and state last year, and it would have went to 34.6. It would have went down almost 2% of payroll if we didn't have to make that assumption change. But making that mortality assumption change brought it to 35.4% of payroll. The very last page I'll bring you to is page 9. And that has your funded ratio. Everybody talks about that, and you want to be in the 80 to 100% range. So you went from 76.6% last year to 78.2% this year. So even with the assumption change, you still went up by 1.6% on your funded ratio. So that was a lot of information quickly, but that was the gist of the valuation report, but I'd be happy to answer any questions.
Anybody?
No, sir. Okay.
Thank you, Frank.
Well, then the board should make a motion to approve the report, and that way it'll be official, and I'll send it to the city and the state.
Motion?
All right, can I get a motion?
I'll make a motion to approve.
I'll second.
Any other discussion? All in favor?
Aye.
Any opposed? The motion passes. Patrick, do you also want to do the declaration of returns?
Sure, let me just make sure it's 7.65. Correct. Yeah, so the declaration would be that the board expects to earn 7.65% for the next year, the next several years, and the long term thereafter. That's what the motion would be. I know we've talked about bringing it down, and I think we did some already. Let me take a look.
Yeah, we were at 7.75, I think, or something, right?
Right, we went from 7.75 to 7.65, but I think the board should keep that in their mind because, we do statistics every year of all of our plans, and the average last year was 7.1%. So you are still on, I know you got a letter from the state too a while ago. The board might want to consider approving like each of the next 5 years to go down by 10 basis points a year or something. And that way, in 5 years, you'd be at 7.15%. Just something to think about. It'll, each time then there'll be a slight increase in that funding requirement to the city. When we lower the expected investment return, that increases the required contribution. But because we have these deferred investment gains from 2023, 4, and 5, my expectation is the costs are going to come down a little bit next year. So, if you guys approve going down 10 basis points, it would probably offset that.
Patrick, do you know, I was just going to ask if you just roughly, excuse me, just roughly if you were able to give the board maybe an estimate in terms of what that impact would look like.
Well, we used to say that, excuse me. We used to say that a 0.1% reduction in the investment return assumption would increase the cost by 1% of payroll, but it seems like it's been a little higher than that, so my guess would be 1.5% of payroll. If you just lowered it 10 basis points next year, the city's funding requirements would come up about 1.5% of payroll. But like I said, I expect the investment gains to wash that out. But does that make sense?
When you say investment gains, are you talking about future or this rolling one that you had here?
Well, if you look at page 8, if you guys are already in that area. So see, it says market value of assets in the middle of the page is $26,695,000.
Right.
But the actuarial value, the value that we used for this report, using that smoothing, we used $24,533,000. So we basically have $2.1 million that we're going to recognize in gains over the next 3 years. So it's gains we've already gotten
Right.
that I think will help the next 3 years of funding requirements. I mean, that's not to say we could have a terrible year this year and lose 20% and the city's costs could still go up. But I'm just saying that based on the gains we've already had, if everything stays neutral the next 3 years, the contribution should come down a little bit, based on that.
And just so you know, this is very standard in all the plans that I'm doing, is this glide path coming down, and especially at a time when the cities are hopefully, like Patrick said, gonna have a little bit better, positive number to offset this, instead of doing it all at one time and coming down 3 or 4 basis points, doing the slow glide down, is actually more feasible for the city, but this is a normal, you're actually probably one of the highest that I've seen at 7.65.
Okay, thank you.
So the motion for the declaration of returns,
So for that, I think we should stick with 7.65.
okay,
Because the state wants it to look like your valuation. If you say, oh, we assume 7.15, then they'll be like, why did you just do the valuation at 7.65? So I would keep the declaration at 7.65.
and then in the next time we do this, we would then start to glide down.
I agree with that, just to avoid, next year, if we lower it again, then, obviously our rate declaration would be the 10 basis points lower, but this way, at least it saves us the trouble, maybe is a big word, but of having to kind of, respond to the state saying, well, it's because we passed this amendment and we're gonna be lowering it, et cetera, et cetera. This just saves us some time and effort
Okay.
and
Appreciate it.
avoids confusion on their end.
So then the motion would be to approve the declaration of returns at 7.65%.
I'll make that motion.
Second.
Any other discussion? All in favor?
Aye.
Any opposed? Okay.
So
motion
do you
passes.
want to do that other motion then to
To
go
start
down
it.
by 10 basis points for each of the next 5 years?
And I would support that as well, especially, again, you have over $2 million of bank money, right? And then on top of that, the city has a $200,000.
Patrick, is this something that they can do later? Is this something you think?
Yeah, they don't have to do it right now. It's fresh on everybody's mind. They would have to
Sure.
do it before, like October 1st, because that's when we would start working on the next valuation report.
Sure. No, I just didn't know if maybe they wanted to wait for the rest of the board or
Yeah,
maybe
that's what I was
think
gonna
about
say,
it some
maybe
more.
if we
But
can make a note for
Thank-
next meeting when we have all 5 here and everyone
Sure.
can kind of,
Yeah, I was gonna, yeah, that might also give us a little better idea of how the year is going
Sure.
too.
Okay. So I'll table this, I'll put this on for next time, and then I could get it started. Pedro can finish up and clarify anything as far as the explanation for the rest of the board. Okay,
Okay.
since you guys got it for Patrick, he probably won't be here next time, but between me starting it, Pedro finishing it, I think we can get that done. Okay?
Well, thanks, guys. I really appreciate you. I'll stick around.
Patrick,
Thank you.
quick question. So as you remember, when your firm first took over, there were discussions about the principal annuity. And to date, we have a little over $2.2 million in that principal annuity. Are you, by chance, keeping track of which participant is tied specifically to the principal annuities?
Right, I believe that in the valuation, we're valuing the non-principal annuities because the principal is covering the benefit payments for those members. I believe, we
Okay.
can talk after the meeting, but,
Okay.
yeah, I could look, but I'm pretty sure that's the way we're doing it.
Got it. Okay, let's talk offline.
Because I think they agreed, we had to keep a bunch of money in there,
Correct.
right? And they argued about it and
Correct.
and we had to keep, $2 million in there or something, like you said. And for that, then they would keep making the monthly benefit payments to the members that were retired at that time,
Right.
I believe.
So at some point, right, let's say 20 years down the road, maybe even less, everyone in that pool could have passed. At some point, we need to get our money back.
Correct.
So just want to make sure that we keep a little bit of an eye
Oh,
on.
yeah, we should keep an eye on that because I'm sure they would
They would-
conveniently forget that, right?
Correct. Okay, we'll have a sidebar. No rush, but just wanted everyone else to be aware of a nuance within this portfolio. Thank you.
Okay, perfect. Thank you, Patrick. Let's see, moving back. Okay, Frank, I guess you're up.
Awesome. And we could go back to Troy's tablets and kick it off on page 15 of the PDFs. It should say 15 of 62, or conversely, at the bottom of the page numbers of our report, it should reflect page 6. So either 15 of the PDF or page 6 of our report in your tablet. So you're looking at a series of numbers, and what you'll find under the third column is a rate of return for the past year equating to 14.5%, or a net gain for a 12-month period of $3.4 million. So again, we're coming off a pretty momentous year, especially in light of all the volatility. I think many of us forgot what already happened back in April when we were actually sitting in losses. So recovering from those April losses and turning that into a 14.5 return does provide a reminder that we aim to invest in the long term. And that's important because just the week, right, with all the noises between Greenland, with the noises between Trump and his fight with the Fed, there's just a whole lot of noises. But if people sold, and some people did, then they would have never recovered some of the recoveries, right? In the last 3 days, I believe the market is up more than 3.5%. So there's a lot of noise that's driving the market. And again, that is not how we invest, nor do we hope that you invest as well. So just wanted to offer a reminder that we are afforded the ability to invest towards the long term. And then on page 9, I will share it with the team here that, we have taken some risk off the table over the last year, and I think we're at a pretty good spot. So on page 9, that shows the subsequent, or page 18 of the PDF, it shows the subsequent allocations since 2021. So if you look at our asset allocation periods, you can see that the blue bar on those pages have progressively increased. But over this past year, we've actually taken a little bit off and invested more in international. And that was really favorable because if you think about the overall investments international, the U.S. currency had weakened, and consequently, our foreign investments really served as a great hedge. And as a result, international became one of our best performing asset class within your portfolio. And if you look on page 19 of 62, or page number 10 of our report, you'll see that middle of that page, or middle of that section, there's a green line highlighting international equities. So international equities under that green line suggested a return of 29.7%. So all of the changes that we have done in your portfolio, whether it is reducing the overall domestic equity or whether it's adding to the idea of international, again, it's proven to be, fortunately, on the right track. And, I've joked around and doubled as your travel agent in the past. And if you remember, a year and a half ago, I had suggested everyone go to Japan. Then I said, no more Japan, right? Because last year, if you think about the US dollar versus other currencies, the Japanese yen at one point last year equaled a $1 US dollar would equal 160 Japanese yen. And then by June of last year, it became 140. So the dollar weakened and the yen strengthened. But interestingly enough, Japan should be back on your radar because now Japan's in a serious economic trouble and their yen is going back up. So $1 US is now back up to 160 Japanese yen, right? This, again, suggests that even though the US dollar is weakened, there's still structural problems in other parts of the world. So it's not necessarily prudent over the long run to bet against the US dollar, and that's not what we're doing. All we're doing is simply getting back to our target where we're a little bit closer. But it just so happens that over the last year, that hedge against the dollar on a global scale did perform favorably. And again, just to highlight the growth of this plan and also the distribution of the plan on page 14 of our report, or 23 of the PDF. So on page 14, you'll see a blue line versus a green line, and that blue line suggests that this plan, again, has reached a new peak in market values. And that new peak in market values creates a larger spread. So the gap between the blue and the green is something that we want to continue to expand, right? That represents investment earnings. But I do think it's always worthwhile to point out that your plan is maturing, right? So sometimes when Patrick says, as a percentage of payroll, maybe the dollar amount is increasing. Well, that's because, again, you have a larger base of retirees than you do with actives. As noted here, your green line is drawing down more money out of this plan, right? On a quarterly basis, I believe this plan actually draws more than $300,000. So we are paying a lot of benefits throughout time, but we're able to support it. And this is a perfect example of why pensions exist. Because at the end of the day, there are some contributions by the employer. There are some contributions by the police officers. But in large, the majority of the growth in the plan comes from investment earnings. And so far, it's shown that the investment returns are sustainable. We have a goal of 7.65, but here, again, we're fairly close over the last 5 years at a goal of 7.5%. So give and take, a couple of good quarters, we could go above it, right? And again, give and take, a couple of bad quarters, we can go below it. But I think the actuarial mechanisms are in place to make sure that no one feels the pain over a volatile period of time. And then lastly, to know, I don't have updated rankings for your plans yet, but if I were to show you how well your plans perform on page 16 or page 25 of the PDF, those bar charts on a year-by-year basis, if you recall, your plan on at least 75% of the times, right, if not more than that, has consistently ranked in the top among your peer group. And we are not trying to hit home runs, right? But instead, our objective is to make that 7.65% or 7.55% to be, right, with a high degree of certainty. So again, in any given year, we hope we don't lose as much when your peers goes down, which as illustrated in 2022, where an average pension plan lost close to 15%. Your plan lost 13 and change. And again, back in 2008, right, when some plans lost as much as 20%, whereas yours lost 15. So we don't hit home runs, but we also try not to lose as much. So risk management has been a part of what we have tried to do, and by way of simply reducing our risk on assets in times as appropriate. And this is a year that will likely to reduce our overall equity exposures more. And we'll do so when times that we need to make payments. We're not aiming to do it urgently. So last year, where we saw elevated risk in the market, we did take some risk off the table. But I think we're at a good spot. We don't need to take aggressive amount of equities off the table. So this year, as we meet with Troy and your custodian to talk about the distributions and the cash flow needs of this plan, we'll utilize those opportunities as a way to reduce risk in your portfolio. So again, going forward, we're likely to reduce the equity profits that we have made and use that as a source of payment for benefit disbursements. Otherwise, no other urgencies from us in terms of de-risking your portfolio, even though we are feeling a little bit more volatility as we kick off this new calendar year. So I'm happy to shut up here and leave it with mostly good news here with you guys. And again, coming off a year with 14.5, I would say that's certainly worth celebrating.
Thank you, Frank.
Yes, sir.
And then Frank, did you want to review the IPS update?
Absolutely. So in front of you, there is a one-page document.
It's also on page 40 of 62, but you've got it in front of you.
Perfect. Thank you, Troy. So just to keep it simple and highlighted in red font is the new section that was recommended by your council. This section suggests that we should add a paragraph to mirror the Florida statute. And that statute says we don't want to deal with companies that is boycotting Israel. And this is directly out of Florida statute, chapter 215. So what we want to do is simply recognize that as part of our compliance and then acknowledge it as part of our investment policy statement. There were no other changes to the investment policy statement. Therefore, I only printed this page. So assuming that everyone's comfortable and approves this language, then we're happy to ask, Troy to circulate for signature at end of the meeting today.
And trustees, if you want, I can piggyback off of Frank's comments. I think
Go ahead.
we may have discussed this before. But essentially, this was a change to the statutes, which, as Frank mentioned, we've already been abiding by for many years. This is originally back over a decade now, the Protecting Florida's Investments Act. And that has been amended since its inception to originally was companies doing business with Sudan and Iran. At the time, obviously, Iran because of the political turmoil, and Sudan at the time because of the genocide. But over the course of these past many years, other countries have been added to that, right? So Cuba, North Korea, China to a certain extent. And so now, most recently, these anti-Israel or boycotting of Israel. And so not because we're not in compliance with it, but just to put a finer point in the investment policy and to address specifically the verbiage in the text. That's why we've been recommending to go ahead and amend the investment policy statement to account for it.
I guess with that in mind, is there a motion to approve the language to match the statute?
Yes. Motion.
So if you're good with that.
Pedro, could you look at the last sentence of it? It seems to, maybe I'm reading it wrong, but it seems to contradict. It says, above it, it says, must be divested within 12 months of the initial appearance. And it says, if the divestiture is accomplished and the company is subsequently removed from the list, the manager can continue to hold. Now, does that mean he can continue to hold during the 12 months? It seems to be counter, but maybe it's just from the statute, I don't know.
Sure. So I understand. So no, that language is not from the statute. But I, my interpretation of that was always, if at some point during those 12 months, right, the company is taken off of the list, then the manager can obviously,
okay.
Continue to hold that share or that position.
So the assumption there is that he didn't get taken, the manager didn't get rid of the thing during the 12-month period you had to take this person off, and they got back on, the clock kind of unstopped and they could go ahead and continue.
Correct. Yes, sir. That's my understanding. That's right.
Okay, thank you.
Yep.
I'll make a motion to approve as displayed in the red on the tablet.
I'll second it.
Any other discussion? All in favor?
Aye.
Any opposed? Okay, motion passes. Perfect. Thank you, Frank.
Thank you.
And we'll make sure that you sign that, Palmer, at the end of the meeting.
This one right here?
Yeah.
Okay, got it.
Yep. There should be a clean one. Yeah, I think that's it. Yep. Okay. Moving on down to Pedro. You're up.
Okay. So my report will be short and sweet. Nothing to report on from a legal perspective. I did just want to maybe point out, obviously, legislative session. You guys are likely aware. It has begun. We started early this year. There hasn't been anything filed that I've seen that would affect our plan or I guess maybe tangentially FRS. But certainly we're still early on, and so if anything does come through the pipeline, we'll certainly keep you posted. But as of now, there hasn't been anything that I've seen that would affect our plan, which in my mind is always it's always good when the legislature kind of leaves us alone for a little bit. Educational opportunities, the FPPTA is having its winter conference coming up February 1st through the 3rd, so about 2 weeks or so. If anybody's going to be there, I'll be there as well. Look forward to seeing you. It's over in Orlando, so not too far from you guys at the Rosen Center. But other than that, nothing really to report on from my end.
Okay, perfect.
Thanks, Pedro.
Yes, sir.
Move on down to old business. Don't see anything there. Anybody have anything for old business? Okay. Consent agenda. So the consent agenda is all of our warrants that have been paid, all of our bills that are paid, and then anybody that's exited and has taken money from the plan, such as in a retirement, a drop, a share plan, or anything like that. That's also all included in the consent agenda. If there's any questions, I'll answer those. Otherwise, I'll be looking for a motion to approve the consent agenda as a whole.
I'll make a motion to approve the consent agenda items.
I'll second it.
Okay. Any other discussion? All in favor?
Aye.
Any opposed? Okay, thank you. Consent agenda passes. And moving right along down to my section, under staff reports. Like Pedro said, the one school is coming up. You would literally have to sign up for it today if it's even possible. If you're already signed up, great. Make sure you say hi to Pedro when you're there. There'll be several people from Foster and Foster there as well. I'm not sure if I'm going to make it there. I might try to socialize one evening, but we'll see. And then the next one is going to be, I just went ahead and put it on there so that you guys could plan ahead, is the annual conference for FPBTA, June 28th through July 1st. That's the one that fills up the fastest. It's the biggest. So if you want to do that, I would say to get in touch with us 2 months before. They may not open it up quite that soon, but what we do is we get a list going of everybody so that the day that it opens, the analyst that's in charge of your plan immediately gets you signed up, and then from there sends you information about the hotel. We do have, if you haven't had this yet, we do have a questionnaire that we ask you to fill out. This helps us to sign people up correctly and to track you if you're in CPPT, if you're doing the beginner, intermediate, or the advanced. So we try to track that for you, so we keep everybody's record of where they are. So as soon as you know, like I said, within two months of the class, so maybe beginning of May, start to reach out, send me an email, and I will put this on the next meeting agenda as well, as a reminder. And that's it for me. We're all the way down to trustee reports, discussion, action. Anything you guys want to discuss amongst each other that you can't due to sunshine laws?
Yep.
No, sir.
Okay, Frank, Pedro, everybody good? Okay, and it's 2:56, and we will go ahead and call this adjourned. And the next meeting is as approved in that list in the red. Okay. Thank you. Thank you, Pedro. We will see you shortly.
Yep. Thank you, guys. I appreciate it.
Okay, take care.
All right, trustees. I'll see you guys at the FPPTA if you're there.
Okay.